everybody, it is Friday, the 4th of January, and the first closing week of the new year. Hope it was good for you. The market did bounce back here so far. We have a positive gain for the year, only thanks to a big gap up and continued rally here today. So let's take a look at the action on the charts. Here's the S&P 500 on a daily time frame. We've got a declining 20-day moving average, declining 50, declining 200. That tells us we still don't trust this rally, but if your short-term trading is what you're looking for, then today obviously was an up day. For the week, again, we're positive. Let's take a look at what that means in terms of the year-to-date volume-weighted average price, which we'll begin to start tracking throughout the year. So that would obviously be 3 days ago right here. And let me just reposition that and then put it so it will go on all of these charts, and then we can continue to watch that on all the time frames. So here's our year-to-date volume-weighted average price. Yesterday, of course, that was the 2-day volume-weighted average price. Hope you caught that tweet that warned you that it was upcoming as potential resistance, because that's where it got slammed from. It came right down to the volume-weighted average price from the pre-Christmas low right here, pre-Christmas gap down, and then today, obviously, we gapped up and looks like squeezed some short sellers. So the primary trend on the daily time frame is still lower. Short term, it remains very tricky here. I mean, yesterday it looked kind of like the end of the world here, closing right on its lows and looking like it had the potential to maybe come down and do some further probing of the prior lows. But for now, we're trending higher here on an intermediate term time frame. The volume weighted average price from the December high is just overhead. I would think that that's a likely area for potential resistance this coming week, and then perhaps we settle down a little bit. If you caught it earlier in the week, I'd actually thought that we were going to get up towards that blue volume weighted average price after a pullback down in towards the 5-day moving average. We of course went a little bit lower, and that's what makes it so tricky. We have multiple time frames and multiple trends here. The weekly time frame, we're still heavily damaged. We came down to the 200-week moving average on the daily time frame. Again, we have lower highs and lower lows. You can start to look at this as a potential higher low that we will start to measure risk against, and that's something that we'll of course keep an eye on. That was a little bit of a reactionary low. The NASDAQ also still having troubles overall. We're coming up into a potential level of resistance where this prior support. We also have this declining 20-day moving average right here, and the weekly time frame, we still have a bigger picture worth a market that's broken. So you've got to be nimble in this market, and the volume weighted average price for the year, let's go to the 10-minute time frame, is where I believe I put that on. So it didn't stick. Why is that? I think I didn't click it to save on all charts, on all symbols. So there it is, and there's our year-to-date volume-weighted average price. And back to the 15-minute time frame, you can see we are above a rising 5-day moving average, but it still is tricky. We came right up to the VWAP from the December high. That is after breaking this trend line earlier in the week. We came up to the trend line and failed there and broke down, and today of course things changed dramatically. So what we'll be looking for now is that this area down near about this 153.5, 154 is our new potential level of support in this market, but still fragile overall. The Russell 2000, like all these markets, came right up to the volume weight, the 20-day moving average, as well as the volume weighted average price off that December high, and now I would expect that it's likely to settle down in here. If we take a look at Fibonacci and say, what kind of retracement of this sell-off have we seen right now, you can see we're right at a 38.2% retracement. So, after the run that we've had, it seems likely that we do pull back a little bit. I certainly wouldn't sell short against this, upward trend here of the short-term time frame, but I'd be on lookout for some potential pullback in there. And again, it just remains very tricky. Look at how these semiconductors were this week. They had given up a huge gain on, or a big, taken a huge loss on Thursday. Today we gapped up and erased all of that and turned positive for the 3 days that we've seen this year. And you can see that here's the volume weighted average price year to date. What we'll be looking for next week is maybe a pullback in towards this level here at about 85.5. If that starts to hold as some support, then maybe this market can build a little bit and be able to sustain a little bit further uptrend. But again, very difficult to trust all these markets. Even the biotechs, which had a great week due to some takeover activity in there of Celgene, it came right up to this prior level of support. As we know, prior support tends to act as resistance. Some people will say, hey, the market's at resistance. I will tell you, don't listen to those people. It's at a potential level of resistance, further reinforced by the declining 50-day moving average in here. It doesn't mean short against it, because unless you want to fight the near-term momentum, which is clearly higher. So again, time to be just very choosy in this market. I know I'm repeating myself here, but the fact is you can be chasing your tail in either direction in this market, and really, I think a lot of people who are trying to do that are finding it quite frustrating. The financials did bounce back further here this week as well. So from their post-holiday low, we did hold above the volume weighted average price on Thursday's close, as well as the volume weighted average price from the Fed. So now we bounce right up to where? Right up to that volume weighted average price off of this high right here. So right now, we're in a potential level where we should see some backing and filling. Last thing I want to talk about is Apple. I had posted a couple charts on Twitter about Apple, about how it had come down to the 61.8% retracement of the low from 2016 to the high of 2018. So from there, we pulled back exactly 61.8%, and that's also the location of the rising 200-day moving average. That's important because this 200-day moving average acted as support back in here in 16, and then once again in 13. Both times it came down to that level, it came down dramatically, and then we start to see some further consolidation before the buyers really regain control. So it might be true that the worst is behind the stock for Apple, but it's still a broken stock with lower highs and lower lows. It is not in an uptrend. You'll likely get some bounces in here, but it remains, as I've said, a tricky environment, and I would say it's a new year. Don't feel that fear of missing out, or that you did miss out. We're 3 days into the year. Keep your head straight. Take the low risk, high probability trades. It means you will miss some trades. It will mean you miss some good moves, but discipline beats guessing any day of the week. So thanks for tuning in.